cash reserves? How do I prioritize this or do this?
The CEO actually named his boat.
I don't know how deep my cash reserve should be.
What does it mean to have your cash reserves depleted? Why are so many companies doing it now? And what are the advantages and disadvantages of this strategy? In this video, we'll discuss a very important and relevant topic for business owners and entrepreneurs: overdrawing cash reserves. But before we get there, make sure to subscribe and turn on the notification bell, because I have some special advice for you. You'd be surprised how much money you can save or lose by overdrawing your cash reserves. It could make or break your company. Okay, let's get started. What exactly are cash reserves? Cash reserves are funds available to a company to cover its short-term expenses and obligations. A large cash reserve allows an individual or group of individuals or a company to make a large purchase immediately. It should also ensure that they can cover themselves if they hit a financial snag and need to make a sudden, unexpected payment. Cash reserves are typically kept in a bank account or a liquid investment that can be accessed quickly when needed. Cash is the most liquid form of wealth, but due to its high liquidity and short maturity dates, short-term assets such as 3-month treasure bills or T-bills are also considered cash reserves. Cash reserves are critical to the success of any business because they provide liquidity, flexibility, and security. Alphabet Inc., Apple Inc., and Microsoft Corporation have billions of dollars in cash reserves. Needs vary, but experts recommend that businesses keep 3 to 6 months of operating expenses in cash or highly liquid assets. The amount of cash reserves that banks must hold onto is mandated by the United States Federal Reserve. This amount is calculated as a percentage of deposit liabilities, also known as net transaction accounts, which are the funds that individuals and businesses deposit in banks and must be repaid at some point in the future. But what exactly does it mean to draw on your cash reserves? Overdrawing your cash reserves, on the other hand, means spending more money than you have in your bank account or liquid investment. This results in a negative balance, indicating that you owe money to your bank or investment provider. Going into overdraft refers to overdrawing your cash reserves. Cash credit and overdraft are two types of short-term financing available to customers from financial institutions. Both prevent checks from bouncing or debit cards from being declined when checking accounts do not have enough funds. The main distinction between these types of borrowing is how they are secured. Overdraft protection refers to extending short-term credit to an account holder when their balance falls below zero. Overdraft protection is available in various forms, each functioning differently depending on the banking relationship. Overdraft protection typically connects two accounts, allowing funds to be automatically drawn on a reserve account if the primary account is drawn below zero. This feature can help you avoid overdraft fees or having insufficient funds to complete a transaction. If a customer's account does not have overdraft protection, banks charge a fee of up to $38.50 per overdraft, plus interest on the balance. Overdraft protection can also be sold as a separate, unsecured line of credit linked to the primary account, acting as a loan in case of an overdraft. Overdraft fees are not charged with this type of overdraft protection, but interest is charged on the credit line balance. Business accounts are more likely to receive cash credit, which usually requires some form of collateral. On the other hand, overdrafts permit account holders to have a negative balance without incurring a significant overdraft fee. Isn't that risky and costly? Both yes and no. Overdrawing cash reserves can be a beneficial and strategic move for some businesses, particularly during times of crisis or uncertainty. However, it can also be a risky and costly mistake for others, particularly without proper planning or management. You may be wondering why anyone would want to overdraw their cash reserves. Let's take a look at some of the reasons why businesses are currently overdrawing their cash reserves. The first reason is that cash reserves and organizational efficiency have an inverse relationship. This makes sense, and you can probably relate to it. When things are going well, you're more likely to eat out more frequently, buy a phone you don't need, or keep subscriptions you don't use. The same concept applies to businesses. The more cash they have, the more likely they are to overhire employees, fund low-return projects, and pay excessive salaries. Does this sound like any of the conglomerates we know of? Another factor to consider is that higher cash reserves reduce efficiency, while higher debt levels increase efficiency. In other words, modest cash reserves and debt are optimal for maintaining corporate efficiency. One old school method is to exchange money for something far more valuable. The truth is that the value of money is declining, and not because of inflation. That is, the fundamental value of cash as currency is declining. It is by no means a new trend. Cash has been a suboptimal currency for over a century, since the Federal Reserve was established in 1913. We've been taught that currencies lose value over time because that's all we've ever seen with cash, but this is untrue. Good currencies appreciate in value, and cash has been a great currency for a long time. In fact, the value of money has increased between 1800 and 1900. In 1900, $1 was only worth 67 cents. Consider this, money in the 1900s was more valuable than in 1800s. Of course, the Fed changed this, but that doesn't mean all currencies become inflationary. At least until FDR banned gold in 1933, gold was the new currency. Following the ban, oil became the new currency to hold. Between the 1930s and 1970s, the world's wealthiest people were all those who controlled the oil. However, in the 1980s, and with Reaganomics, the optimal currency shifted to stock, which has remained the case ever since. One argument these companies use to justify overdrafts is that larger cash reserves lead to greater diversification, which appears to be bad. The idea is that companies are far more likely to succeed when they invest in areas where they already have a dominant position, rather than in new areas. However, as cash reserves grow, the temptation to diversify into new businesses grows, frequently resulting in more losses than profits. These hypotheses have simply been strengthened over time by new research. One study, for example, looked at corporate earnings growth from 1871 to 2001. The study discovered that earnings grew the fastest when corporate dividend payout ratios were the highest. In other words, when businesses paid out a majority of their profits. When companies hoarded cash, stock performances suffered. None of this is to say that bloated cash reserves cause poor performance. Rather, bloated cash reserves are a sign of a fundamental shift in a company, which is usually not for the better. On a more recent note, the pandemic is one of the primary reasons businesses are overdrawing their cash reserves. Many businesses around the world have experienced significant disruption and challenges as a result of the pandemic. Some companies have seen a drop in sales, revenue, and profits. Costs, expenses, and debts have risen in some businesses. Opportunities for new horizons are another reason why businesses are overdrawing their cash reserves. To take advantage of the opportunities in the market, some businesses have decided to overdraw their cash reserves. They can invest more money than they have in their bank account or liquid investment by overdrawing their cash reserves. This can assist them in growing their businesses more quickly, improving their products or services, entering new markets or segments, acquiring new customers, or retaining existing ones, and innovating or differentiating themselves from competitors. Overdrawing cash reserves is a useful and strategic move for some businesses, particularly during times of crisis or opportunity. But we've also seen that it can be dangerous and costly of a mistake for others, especially without proper planning or management. However, not drawing enough cash could also be an issue. Isn't it nice to have a lot of money? Not all of the time. Having cash reserves on hand can be useful when there are cash flow issues and money is needed immediately for something. However, it is critical to strike the proper balance because too much can be harmful. Excess cash can result in missed opportunities. Higher returns could have been obtained by reinvesting some of the cash in the business. In theory, the amount of money generated by those investments should easily exceed the rates paid by a checking account. And don't forget to leave a comment below. We'd love to hear from you. Thanks for watching. Until next time.